A 100% hit rate on yesterday's dealer containment zones. Yesterday's proven floor now faces a high-impact data sledgehammer. Welcome to the Gamma Brief. It is Tuesday, June 2nd, 6:45 a.m. Eastern. If you're new here, the Gamma Brief is an experiment. I'm using a layered generative AI pipeline to reliably capture market data, economic events, and structural mechanics, and then turn all of that into accurate, actionable briefings every morning. As always, this is market intelligence, not financial advice. Let's get into it. ES futures are trading at 7,601 with the SPX cash close at 7,600. Yesterday, positive gamma contained the tape, defending the walls exactly as called. If the dealer buffer holds through the morning data, we compress. If it breaks, the regime violently flips. We are opening in positive gamma with a net dealer exposure of positive $5.8 billion. However, the regime is entirely borderline. VIX sits at 16.13, but the options-derived DEX flip at 7,590 is just 10 points below the current futures. In positive gamma, dealers dampen volatility by selling strength and buying weakness. But with the flip so close, a minor flush shifts dealers short, requiring them to chase price and amplify directional moves. Operating near the gamma flip means the overnight structure is transitional and vulnerable to incoming data. The current geometry shows ES futures sitting heavily pinned toward dealer resistance. We are 13 points from the 7,615 call wall, but 52 points above the 7,550 put wall. The 77-point expected move mathematical projection reaches down to 7,524, which threatens a full breach of the put wall, while projecting upside to 7,678, well past the call wall. Notably, ES futures have already cleared R1 at 7,598, leaving the first active resistance at R2, which aligns directly with the call wall. Overnight sentiment was dominated by geopolitical risk. The closure of the Strait of Hormuz has introduced stagflationary pressure, sending crude oil sharply higher and dragging the 10-year yield up 2 basis points. Despite ES futures remaining relatively flat, sector internals show technology up 2.5%, while rate-sensitive real estate lags down 1%. The bond market is hedging, setting the stage for tension against equity multiples. Today's primary threat is the April JOLTs Job Opening report at 10 a.m. Eastern. This is a high-risk event carrying a 4 out of 5 calendar score. A massive beat reinforces higher for longer rate fears and threatens to push price through the gamma flip, while a miss could spark a relief rally toward the call wall. Tell me in the comments, does the JOLTs print break the 7,590 flip, or does positive gamma hold the line? The strategic environment is consistent with defined risk directional setups initiated after the data clears. Selling premium inside the breached wall range is picking up pennies in front of a steamroller as tail risk looms just 10 points away. And early reclaim and hold above 7,615 invalidates the downside threat and favors upside momentum targets. The primary plan demands patience. Wait for JOLTs to clear. And if ES holds above the 7,590 flip and breaks 7,615, upside expansion triggers. Conversely, a post-data failure below 7,590 flips the regime, opening the trapdoor toward the 7,550 put wall. The morning hinges entirely on how dealer positioning absorbs the JOLTs data drop. A break of 7,590 shifts the mechanical hedging flows and unwinds the containment zone. The regime is at a knife's edge. A 20-point move rewrites the dealer playbook. Level set, bias defined, good luck out there. Standard disclaimer remains. This is market intelligence, not financial advice. Options are high risk, manage your size, and trade your own plan.